Do you ever feel that your paycheck vanishes when it hits your account? It's like you blink and it's gone, long before you've had a chance to actually enjoy it. And when retirement enters the conversation, it can feel like you need a small fortune just to get by comfortably. But here's something you might not realize. You don't need to be a millionaire to out-earn your current job. In this video, I'll show you how putting aside just $120 a week into a dividend-focused ETF, specifically SCHD, can not only help relieve financial stress now, but also set the stage for thriving retirement. We'll cover how this strategy can potentially build a portfolio worth more than $2 million and generate passive income of over $180,000 per year. That's over $15,000 a month. Let's start by understanding what SCHD actually is, but first. Welcome to Blue Chip Mindset, the winning mindset for success. If you enjoy the video or learn something new, please give it a like. The Schwab U.S. Dividend Equity ETF, known by its ticker as SCHD, was introduced in 2011. It's since become a go-to option for investors looking for both reliability and income. The fund invests in American companies with a solid track record of paying dividends. SCHD is designed to mirror the Dow Jones U.S. Dividend 100 Index, which screens for top-performing dividend payers using a strict set of rules. What makes this fund appealing is its balance. It's not just about high dividends, but also long-term growth potential. The companies it includes are typically stable, well-established businesses that consistently reward shareholders. That makes it an excellent choice for investors seeking income and asset appreciation. Unlike funds that chase risky high yields, SCHD is more selective. It focuses on strong fundamentals and sustainable dividend growth, avoiding the pitfalls of weaker companies that might slash their payouts during tough times. So how are these companies selected? SCHD follows a detailed screening process built around three main criteria. Dividend consistency. Companies must have paid dividends for at least 10 years in a row. That ensures a commitment to shareholder returns. Growth and payouts. The fund favors businesses that have not only paid dividends but have also increased those payouts over time, reflecting healthy and growing operations. Financial stability. Each company is reviewed for metrics like return on equity and cash flow, meaning only the most financially sound firms make the cut. By investing in SCHD, you're putting your money into a diversified set of 100 top-tier U.S. companies across various industries, such as tech, healthcare, finance, and consumer staples. This mix helps reduce risk by not putting all your eggs in one basket. Top holdings in SCHD include household names like Home Depot, Coca-Cola, BlackRock, Cisco, Lockheed Martin, and Johnson & Johnson. These are industry leaders known for strong business models and consistently rewarding their shareholders. Take Home Depot, for example. It has raised its dividend for over 3 decades. BlackRock, a powerhouse in asset management, has consistently provided solid returns to its investors. And Cisco, a leader in networking technology, combines growth potential with a dependable dividend payout. SCHD's strategy revolves around combining reliability with performance. Its portfolio selection ensures exposure to businesses that can weather economic shifts while still growing shareholder value. Now let's talk numbers. One of the significant draws of SCHD is its historical performance. Since its launch, the ETF has shown strong returns in stock price growth and income generation. Over the past 10 years, it's produced a price return of about 120%. While that's a bit lower than the S&P 500's approximate 200% return, SCHD shines in its dividend income. Investors in this fund benefit from a higher yield, making it an attractive choice for those seeking reliable cash flow. Currently, it offers a dividend yield of around 3.41%, and its dividends have grown at an average rate of 12% per year over the last 5 years. That means your income doesn't stay flat, it grows with time, making your investment more powerful as the years go on. While SCHD might not lead the pack in capital gains, its consistent income and steady growth make it a favorite for long-term wealth building. So having this fund help you generate 6 figures annually. Let's explore what happens when you commit to investing $120 every week into SCHD. A key advantage is its low expense ratio, just 0.06%. That means fewer fees eating into your returns. It also has lower volatility than the broader market, offering a smoother ride during downturns. Its beta is below 1, which means it's less likely to swing wildly compared to the market average. At present, SCHD trades at around $28.33 per share. This reflects a recent 3-for-1 stock split, which brought the price down from the pre-split level of roughly $85.20. Stock splits don't change the total value of your investment, they just increase the number of shares you own while reducing the price per share. The fund is also attractively valued, with a PE ratio of 15.42 and a price-to-book ratio of 2.85. It's sitting in a healthy range, indicating it's reasonably priced relative to the broader market. Backed by major companies like Chevron and Johnson & Johnson, SCHD holds up well even when the economy wobbles. Now let's explore the exciting part, how this investment can replace your salary. Investing $120 weekly might not sound like much, but it becomes a financial powerhouse when combined with time and compounding. As the companies in SCHD continue to grow and raise dividends, your income stream expands. Reinvesting those dividends into more shares accelerates this process even further, setting off a growing income and asset value cycle. Here's a detailed look at how your $120 per week investment could grow. Weekly contribution, $120. Annual total, $6,240. The magic happens when you allow this investment to compound year after year. As your portfolio grows, the dividends you receive are reinvested, buying even more shares. Over time, this accelerates the growth of both your investment and income. Here's what that could look like at various milestones. In 5 years, your initial investment of $6,240 per year, totaling $31,200 after 5 years, could have grown into a portfolio valued at approximately $41,136. This represents a 35% increase in total value, thanks to reinvested dividends and capital appreciation power. This is just the beginning, as the longer you stay invested, the more exponential the growth becomes. In 10 years, after 10 years, assuming you continue your weekly investment of $120, your portfolio could be worth around $149,999. At this point, the total amount you've invested would be $62,400, but your returns would have nearly tripled. This happens because of both your contributions and the continued reinvestment of dividends, which add to the compounding effect. The more shares you own, the more dividends you earn, which in turn buys more shares. In 20 years, fast forward another 10 years, and your investment could reach $558,000. At this stage, your total contributions would have been $124,800. However, thanks to compounding and the steadily growing dividends from the high-quality companies in SCHD, the value of your portfolio has increased more than 4 times. The reinvestment strategy works wonders here, pushing your returns beyond what you'd expect from initial deposits. In 30 years, by the time you're ready to retire, your $120 per week investment could have transformed into a portfolio worth approximately $2,628,133, with a total of $187,200 invested over the years. This is the true power of long-term investing, compounding growth on top of dividend reinvestment, with high-quality companies fueling the returns. Not only has your portfolio grown significantly in value, but it also provides $180,000 in annual dividend income. That translates into $15,000 per month, the kind of passive income that could easily replace your full-time job salary. What's remarkable here is that at the 30-year mark, the dividends are paying you the equivalent of your entire investment over those 3 decades. Each year, you're earning in dividends roughly what you've contributed, without lifting a finger. It's like your portfolio becomes an income-generating machine. This could serve as your retirement pension, giving you the freedom to live comfortably without worrying about budgeting or cutting back. With this steady income stream, you're not relying on selling off assets, making it a secure and stable source of money for years to come. If you enjoyed the video, please like and subscribe.